This is Chuck Horneval. I'm the Chuck in the Markets Up Chuck. And today's presentation is talking about building portfolios with realistic returns in mind. And for the sake of this, the majority of this portfolio, I'm going to stop everything by the end of 2007. My purpose here is to eliminate recession bias. And I'm going to look at what normal and what realistic actually is. Peter Lynch, in his best-selling book, One Up on Wall Street, talked about 9 to 10% a year as a generic long-term return for stocks. He called that the historic market average. My argument would be I kind of like a number that's somewhere between 7 to 12%, a little wider range, but again, that kind of gets you through good times and bad times a little better. But if you look at the S&P 500 over the 15-year period ending in calendar year 2007 and starting in calendar year 1993, the key I want you to focus on here is that earnings growth has averaged about 0.3%. If I take 2007 out, that number would be a little higher. If I added 2008 in, that number will be lower. And the point is, that's a pretty good normal expectation. That's about what businesses are capable of doing over long periods of time. And that's really one of the points. What is a realistic rate of return that you can expect by developing a proper portfolio? Additionally, in his book, One Up on Wall Street, Peter Lynch talked about what he called the 6 categories. He talked about slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. I'm only going to talk about the first 3, slow growers, stalwarts, and fast growers for sake of this presentation, because I'm looking for portfolios here that are designed to be long-term portfolios with a bias towards growth or growth in income, as I'll be developing later on in the week. But the first example here is H.J. Heinz, and I would call this a slow grower. I want you to notice it's had very consistent earnings growth over this 18-year period here. It's averaged about 3.6%. It does pay a nice dividend, which is something I alluded to in the written part of the blog. If you look at the long-term track record, though, this company's appreciation potential has correlated very closely to its 3% plus growth. There was a 4% compounded rate of return. Of course, it does pay a nice dividend, which is part of why you would want to own a Heinz. But you end up with 3.6% earnings growth and a 4.0% rate of return. That's correlates very strong. This I would classify as a slow grower. For this example of a slower grower, I'd use Kimberly-Clark. Again, a very consistent grower, nice dividend yield, grows about 6.8% a year compounded over that 18-year period, and that gave you about a 7.7% rate of return. I want to make a point. This number here correlates very, very closely, just based on a little valuation, to the almost 7% growth rate that the company achieved. And I should add that that's consistent with what the S&P did with an 8.3% earnings growth rate. I might point out the S&P ended up doing 8% compounded rate of return during this 18-year period, from January 31st, 1990 through December 31st, calendar year 2007. Now, the second category Peter talked about were stalwarts, or a little faster growing. Here you see Coca-Cola with a 10.9% compounded growth rate, and interestingly enough, a 10.9% compounded rate of return versus to shareholders, beating the S&P 500 by a couple of percentage points, but once again, correlating very, very closely to its earnings. Another stalwart would be United Technologies. And by the way, I consider stalwarts are companies that can grow between 10 and 15 to 20% a year, and they kind of blend in that range. United Technologies happens to fall into the 15 to 20% growth, a little lower dividend, but it does have a very, very strong growth rate. As you can see, shareholders earned about 18% or very close to its earnings justified growth rate of 18.1% and significantly better than the S&P 500. But this is another case of a stalwart that would be a very excellent, long-term hold for this period. And this also argues very well for the point of buying and holding through this 14-year period has been significantly better than buying and holding the stock market. And if I moved along to these, fast growers that he talks about, here would be Apollo Group, which is a educational company, but it does specialize in, educating older adults, not just young children. You can see it's had a little blip right here from 2003. Its calendar year did have a drop in earnings, but otherwise, and then of course that responded or rebounded with a very, very strong earnings growth. This company's averaged over 37% earnings growth, and shareholders have generated over a 42% rate of return during that period, compared to now a 9.5% number in the S&P, because I did have to chop a year off because this company wasn't quite as long. Actually, several years. This is only a 13-year chart here with Apollo Group, and it's not as old as some of the stalwarts were, but you can see very, very fast growth, very, very high return. Then my final example of a fast grower would be Microsoft. Everybody knows Microsoft has got a little more notoriety or certainly branding than a company like Apollo Group. I want you to ignore this dividend. This is where Microsoft actually paid a very large special dividend one year, but I want you to notice this company's earnings growth has been just under 27% a year, and shareholders have averaged about 25% a year buying and holding those. But Microsoft, leads me to another point. When you're building a portfolio, you can have a very specific rate of return based on the type of companies you're investing in and the mix of those companies and what blending you put into your portfolio. However, one of the part of managing the portfolio is to be careful that those companies actually don't change. To illustrate the point I'm trying to make, let's take a look at General Electric, which is certainly a stalwart. It's an 11% grower, comfortably in that range of between 10 and 20% that I talked about. Or Peter Lynch even talked about in his book. And as you can see, this company grew by 11% a year, paid a nice dividend, generated about an 11% rate of return for its shareholders during this period of time. But this is an example of where the portfolio has to be managed. As long as this company is continuing to do this, you can kind of, have what I would call a reasonable expectation that your returns are going to be consistent with that. But what you have to be on the lookout for in part of portfolio management is if something radically changes. By updating General Electric, you'll see that earnings have really fallen off a cliff because they did have a large finance arm that was got involved in some of the excesses that occurred with the mortgage business, et cetera. I'm not going to get into a long detail there, but I want you to notice it changed the dynamics of this company a lot. We had 2 really bad years in earnings. In fact, we're forecasting a 50% drop currently, and that lowers the growth rate from 11% down to 5%. But interestingly enough, you again get this correlation of 4.7% rate of return, consistent with the stock market during this same period. This is a 20-year period now, but the key point is that, here is a case where the earnings did fall, because remember, it comes down to earnings and valuations we talked about in previous blogs. The real point of the story is, and I'm going to be developing this throughout the week this week, and just talking about how when you're building a portfolio, you can and should have very, very specific rates of return in mind when you're building the portfolio, and that's a benchmark, and I'm going to talk about that tomorrow, that I believe is more important than trying to measure it against an industry like the S&P 500, for example. What you want to do is have a realistic expectation that your portfolio is capable of generating for you based on the amount of risk you're willing to take, as well as, the type of investments that you're choosing and how much growth versus how much income you choose. And I'll be talking about that all week. It's Chuck Carnevale saying thanks for listening, and I look forward to talking to you again.